Imagine two people receiving the exact same paycheck. They live in the same neighborhood, shop at the same stores, and navigate the same economy. After 10 years, their lives diverge. One individual holds assets that generate cash while they sleep. The other holds possessions that lose value. We often credit high IQ or luck for this success, but data shows intelligence and chance rarely dictate wealth. The real friction exists in the human brain. For thousands of years, survival depended on consuming resources the moment they were found. Our biology prioritizes the immediate dopamine hit of a purchase today over the abstract, distant reward of a portfolio 30 years in the future. Investors and consumers inhabit different psychological realities. They see the same dollar bill, but they process its potential through entirely different filters. Escaping lifelong financial dependency starts with identifying when you are operating on this default consumption-heavy setting. The divide begins with the definition of a dollar. To a consumer, money is an endpoint, a voucher to be traded for a finished product. To an investor, money is a laborer meant to be sent out into the world to collect more money. When capital is available, the consumer focuses on the present. What can this money buy right now? The investor looks at the horizon. What can this money grow into over time? This logic separates those who pay for access from those who hold ownership. Consumers spend their lives funding businesses. Investors spend their lives acquiring them. We see it in every transaction. The consumer buys the latest smartphone to use it. The investor buys shares of the manufacturer to profit from everyone else using it. When looking at a company, the consumer notices the brand's image and the cost of the goods. The investor ignores the branding to focus on cash flow and market expansion. Deciding to treat money as a seed rather than a resource transforms a one-time expense into a permanent claim on future earnings. Modern spending is fueled by a primal need for tribal validation. We are biologically incentivized to signal our status so we aren't left behind. Consumers often use debt to amplify this signal, purchasing the appearance of wealth to gain immediate social approval. Investors opt out of this signaling game. They willingly endure the social cost of appearing average while they build the structural reality of success behind the scenes. This also alters the definition of safety. The consumer looks at the stock market and sees the danger of a sudden crash. The investor looks at a savings account and sees the danger of inflation and the permanence of the 40-hour workweek. To them, the greatest risk is needing to trade labor for survival forever. Chasing visible status keeps a person tethered to their next paycheck. Accepting the friction of delayed gratification is what eventually buys an exit from that cycle. There is a deep irony in financial freedom. Real wealth is almost entirely invisible to the casual observer. You cannot see a high savings rate or the momentum of compound interest. By the time the results of these habits manifest as a lifestyle change, the gap between the investor and their peers has become an unbridgeable canyon. The math of repetition is relentless. Small, daily choices to prioritize ownership accumulate over decades. One path leads to a zero-sum existence, while the other builds a self-sustaining machine. These compounded decisions eventually create two different physical realities. One is defined by the crushing weight of liabilities, the other by the buoyancy of assets. Investors treat currency as a tool to purchase the only asset that truly matters, their own time. They buy the ability to control their schedule, shifting the internal question from "what can I buy?" to "what can I own?" determines the trajectory of a life. It is the difference between working for money and having money work for you. Ultimately, consumers buy things, investors buy time.